Hello and welcome to the Swiss Re Corporate Solutions webinar, Innovative Insurance Solutions for the Hardening Market in Latin America. Thank you everyone for joining. I really hope you all are safe and healthy. Before we get started, I would like to bring your attention to the Q&A chat box on the left side of your screen. Please type in any questions that you may have throughout the webinar. And if you are experiencing any technical difficulties during the webinar, please, using your keyboard, hit the keys Ctrl plus F5. Well, now let's get started. Today we will talk about a hardening insurance market, what contributes to its current state, and briefly look at some alternative risk transfer solutions out there. Joining me today, I have Andrea Bayer, Head of Innovative Risk Solutions for Latin America, Thomas Keist, Global Captive Solutions Leader, and Thomas Holzheu, Chief Economist Americas from the Swiss Re Institute. We will kick off the webinar with a brief economic overview. So with this, Thomas, I will pass on to you. The floor is yours.
Thank you, Oscar, for the introduction, and welcome everybody. I'm glad that we have so many people joining and showing interest in this topic. I will start off here with a very high-level overview of where the economy is and talking about some of the key drivers for the current hard market. So first off, where do we stand in terms of the global economy or the economy in the Americas? And after the initial shock of the economies worldwide getting to a very sudden stop and the most severe recession on record for quite a while, we are now entering this phase of reopening. And if you look at some of the high-frequency data that's available on mobility and on consumer spending, we do see that economic activity in many countries has bottomed out in April and has started to recover to some degree since. This is all tied into the speed of reopening, and the reopening should be tied to progress on the pandemic curve and the improvement on dealing with the pandemic. In that respect, things look a little bit more messy, and the Americas actually lag in terms of the ability to reopen, or in terms of the development on the pandemic curve. Americas lag Europe and Asia, and in that respect also the readiness to reopen is lower. We see this as rising cases in the US, but then of course also in Brazil and in Mexico, and this is posing risks going forward, and somehow uncertainties around the future speed of this reopening and then the subsequent economic recovery. The one country that has suffered through the crisis the first and has the longest experience with reopening is China, and we can gain some experience there on how gradually the economy is able to cope with the new environment and with the reopening. We don't expect that this is a complete V-shaped recovery and that things will go back to pre-crisis activities very quickly. So while we see some very immediate quick rebound, certain parts of consumption behavior changes will lag behind for some while to come, and this is anything related to entertainment and tourism, travel, some of the obvious segments that are where social distancing will carry on, and change in behavior will last longer, basically until we do have a vaccine and treatment options. These parts of the economy will take longer to recover. So at the end of the year, and we will not have a recovery, a full recovery but maybe get back to, and this varies then by country, we'll probably have to deal with a 95% economy or less than that. We saw labor markets turn down very quickly and lead into the downturn. We expect that the recovery of the labor markets will be more protracted, and companies will not hire right away, and some change in behavior and uncertainty will lead to a slower path of recovery of labor, of employment, and with that we will have some effects on income and spending. As one of the results of the central banks providing a lot of stimulus in also unprecedented speed and volume, interest rates are low, and we expect this to be with us for the next couple of years. So a low interest rate environment is one of the new paradigms, and all this is and also one of the reasons why policy stimulus will remain strong. There is a lot of uncertainty around. For once, as I mentioned before, the trajectory or the development of the pandemic itself, but then also there's a lot of uncertainty about the economic the interdependencies between countries and how this reopening will work out. So what are some of the impacts on the insurance markets? And look at the difference between short-term and longer-term impacts. On the short term, there is, with a lack of employment and a lack of economic activity, we see a slump in demand that varies by line of business. Insurance companies themselves are in addition affected by stress on balance sheets. There's asset valuations are strained. There's as a result of some of the lower revenues, there's earnings and cash flow stress. So overall, insurance companies in their balance sheets and operations are exposed to this to slump in demand and financial market stress, and also uncertainty on the claims side. So this adds to a reduction in capacity, and at the same time, in terms of demand, there's more risk around, and also there's less appetite for risk in the financial market. So this is a situation which leads to the market hardening. As a result of that, we often see a flight to quality, and that's as one of the immediate reactions to the uncertainty and to withdrawal of capacity. In the longer term, there's much higher levels of government debt. There's a lot of monetary stimulus in the global financial system. This creates uncertainties around inflation. At the same time, to deal with this with these high levels of government debt and the economic uncertainty, central banks will keep interest rates low for longer time, and so these two effects are causing each other and relating to each other. The crisis itself has created risk awareness in various areas. This, for once, is on personal lines on the consumer level. There's clearly increased awareness on mortality, critical illness, and health-related risks, and according insurance covers. But then, of course, on the commercial insurance side, business interruption, contingent business interruption, and particularly also the area of non-damage business interruption are on the agenda, and so this is something that will, going forward, change risk management, some of the attention on that, and make some changes to also insurance demand necessary. And then, as a different direction, as a result of these the social distancing, there's a changed consumer experience regarding how to shop, how to interact with companies, and digitization has definitely gotten a big boost. And we expect that this will be also playing out for the insurance industry and particularly also the distribution networks. So how does this play out now into the market hardening? And I want to highlight a couple of trends. Some of them have started also before, and this market hardening has begun before the COVID crisis hit. And so there are trends on the property side, on the casualty side, that both make the risks more complicated and basically decommoditize some of these risks and make it more difficult to assume. And on the property side, we saw uncertainty around coverage issues, loss creep, and now we see it in relating to the COVID crisis. There are additional issues around business interruption coverage issues. So property becomes, in a sense, more long tail, and modeling uncertainty for certain cat perils has increased as experience out of the last couple of years. And we also realized that exposures have increased strongly through socioeconomic development, and not all of this was properly captured in a lot of the risk models as it turned out over the last couple of years. And on the other end, in casualty, there's of course the paradigm shift that these low interest rates change the economics, and there will be simply much less support of earnings from investment income. And then also, on the other hand, claims were trending up, strongly a US phenomenon, but also in some other economies. We see some of these developments that we call social inflation, and so there is some pressure on the casualty lines from that. In between, as in terms of capacity, the alternative capital that found the property space very attractive through many of the years after 2014-15 has run into some realization that a lot of the models are less predictable on some of the risks. There's unmodeled exposures, there's correlations that were unanticipated, and at the same time there's also less risk appetite and more attractive returns in other areas. So overall there's less interest in and less capacity flowing into the market from this alternative capital trend. So as mentioned, this has led to a hardening of the market. This has started before the COVID crisis has hit, and we expect this to accelerate or extend through the factors as just mentioned. And in the slide here, we just show some of these trends, and we see that it's in all regions of the world. Some regions where we had additional cat losses, or these like in Australia, or the social inflation like in the US, experience additional pressures and additional rate increases as a result. Now, I mentioned the cat losses and the modeling of cat losses, that there is increased uncertainty, and this ties into a bigger theme that we are following at the Swiss Re Institute, and this is how climate change actually is adding to these uncertainties. And we think we are at a point where this is increasingly we're realizing that certain perils are already affected by climate change, and we see loss trends going up as a result of this. This is particularly in the secondary perils, so perils like flood or hailstorm or tornadoes, these wildfires, drought. A lot of these perils where we will have much more frequency, we can analyze these relationships better, and we see also we have some clearer relationships to changes in the climate. So higher average temperatures, they lead to storm surges, rising sea levels. There's a pretty high confidence about these relationships. We see more extreme weather events, and heat waves and drought are related to that. Also, higher temperatures will lead to more moisture, more ability to capture water in the air, and as a result of that, we get more extreme rainfall and river floods. These are areas where science and observation of on the loss side play hand in hand. Then there's areas like the impact on the frequency of hurricanes, cyclones, and winter storms, hail and tornado, where the evidence is not so clear yet, but where we also see some indication, some increase in losses. We're not so sure about the science yet, but which doesn't mean that it's not there. But what does it mean for insuring risks? Weather risk are still is insurable, but it's more difficult to get it right, and that's I think one of the key areas here. If you look here at this chart, just to illustrate, if you look at the trend, and let's assume this is some climate-related metric that's related to exposure. Traditionally, we try to capture as much data as possible to get as many observations. But if there's a trend in there, then we underestimate the current level of the risk, which would be the line in at the middle of this the vertical line in the middle of this chart indicates the current time horizon. If we don't capture this trend right, and there's a trend, then we underestimate the risk. And this is the experience of the last couple of years has shown in several areas that there were surprises in models, and some of this may relate to climate change, some of it had related to simply the economic development, strong growth, particularly of particular importance in fast-growing economies. We realize it is simply more difficult, increasingly more difficult to get these models right, and underwriting and modeling these risks is dealing with a moving target. I'm pausing here now with my part and hand over to Andrea, and she will get much more into detail than relating the market situation.
Thank you, Thomas, for this very comprehensive overview. Welcome everybody from my side as well to this webinar. I quickly would like to introduce you to our global team within Swiss Re Corporate Solutions. Our Innovative Risk Solutions team was established in 2012, and ever since then we closed more than 650 transactions. And since 2018, we also have a local presence in Latin America, with having me in our office in Miami and my colleague Jose Antonio Izaguirre based in Mexico. We are also accompanied today by our colleague Thomas Keist, who helps us in the global team with all matter related to captives. So let's deep dive into what Thomas just described from a macro point of view, the hard market trends we have observed in the latest couple of months, and also the last 2 years, where we see clear hard market also in Latin America, the needs and the solutions we can provide. So basically, the overall economic uncertainty is what is currently present. We see a lot of pressure on budgets, also now given the COVID-19 crisis. We have seen rate increases and more and more scarcity of capacity. There is carriers pulling back capacity. We have, for example, seen less risk appetite for beachfront locations in the Caribbean, just to mention a few examples. Overall, the budget constraints result in a reduction of limits which are being bought by our clients, and also an increase in self-insured retentions and deductibles, along with less broader coverages and exclusions which we see in traditional policies these days. And that clearly raises a need for broader coverage for everything which is now underinsured or uninsured. to cover for the bigger self-insured retentions and deductibles, to provide cost certainty over the medium term, all sorts of non-physical damage, business interruption exposures we have now discovered, and then also fast payouts, specifically when it's related to severe NatCat events. So the solutions we would like to present today are our state-of-the-art parametric NatCat solutions. We quickly touch base on non-physical damage, business interruption, and other non-NatCat related triggers, our multi-year carve-outs, and everything around captives, including our new concept for virtual captives. So let's start with our parametric solutions. Parametric covers are based on pre-agreed limits, payout structures, and triggers, and whenever those triggers are being met, a payout occurs. So that's actually one of the key benefits, a fast payout where we typically pay within 30 days after an event occurred. So the client can use the payout for any post-immediate emergency expenses to get the business back as fast as possible, and the funds can actually be used for any cost occurred. And there is no claim adjustment process. So that's why, this payout is really, really fast. So parametric solutions, the way we offer them is as a complement to our traditional policies. And what we just described, anything which is these days underinsured, uninsured, that could be in a property policy. If we have a hotel, for example, these days we don't cover any golf courses, tennis courts, foundations, loss of beach, all these type of exposures which are not covered anymore, they can be covered based with a parametric insurance policy. We have a lot of NatCat exposure in Latin America, so primarily earthquake and hurricane, and we have developed solutions for that. Before we dive deep into that, we also see more and more inquiries for excess of rain coverages because each hurricane is also different. It's sometimes not the strength of the hurricane causing the losses, but what we saw in Hurricane Harvey, for example, that Houston was very much impacted by the heavy rain which was brought with the hurricane as well. So we see that increase in inquiries as well. So any other type of non-NatCat related triggers, what is very important to mention here, just as a disclaimer, Swiss Re Corporate Solutions, we don't have risk appetite for pandemics, strikes, riots, civil commotion, and the like type of coverages. Nevertheless, we can look at your specific inquiry and we can analyze if we can set up specific triggers for the specific circumstances. So what's important here is always that we have a correlation with the financial loss, that the trigger is measurable. The trigger is also provided by a third-party provider, and we have historical data which we can analyze to establish an expected loss, obviously, but also to set the triggers right. We had a separate webinar about non-physical damage business interruption, and we are happy to provide the link. It can be found on LinkedIn on the Swiss Re Corporate Solutions webpage. Now, diving a little bit deeper into our advanced Swiss Re Corporate Solutions Storm and Quake solution. So Storm is a solution for hurricane. So with that solution, we have a clear benefit of not only looking at a maximum wind speed, which is reported by the National Hurricane Center, somewhere within the windstorm, but we actually are able to look at the localized impact, the wind speed at the location of a client or a insurable interest of a client. And we use a third-party provider, which in this case is RMS, Atrin Scientific, and they provide us with a wind footprint, which determines the wind speed at a 1 by 1 kilometer grid. And with that, we are able to determine the wind speed at the specific location of interest. And it's a compilation of all available data measured by aircraft, satellite, and local weather stations. So how does that actually look like? How does a cover work? So we have an example here, Hurricane Wilma in 2005 and a hotel operator in Cancun in Mexico. The wind speed at this very specific hotel location was 90.3 miles per hour. The pre-agreed payout structure was a 25% payout if the wind speed at that location exceeds 70 miles per hour, 50% if it exceeds 80 miles, 75% if it exceeds 90, and 100% if it exceeds 100 miles per hour of the pre-agreed limit, in this case of 5 million. So the 90.3 miles per hour would have triggered a payout of 75%, which equals 3.75 million out of the 5 million pre-agreed. How does it work for quake? The same methodology, the same principle is applied in our quake solution. Again, here, if we only look at a magnitude-based trigger, it does not really take care of localized impacts, right? So what is really important to a client is how the earthquake unfolds, how the energy unfolds, and how it impacts, and what shake intensity is experienced at those locations of interest. And with that, we have, again, a better correlation between the direct and indirect financial loss and the severity of the shake intensity experienced at the location of interest. In USGS, I'm sure you know all about the United States Geological Service is a publicly available data source. Everybody can go on the web page and check not only the magnitude, but also the shake intensity of each earthquake event. And also here, a quick example of the Guatemala earthquake. The shake intensity experienced at the Guatemala city center here was 79%. Peak spectral acceleration, a measurement for shake intensity, and the epicenter was quite far away. Based on the payout structure, which was pre-agreed, the payout would here have been on a limit of 10 million, 80%, and a payout of 8 million. So what is important to summarize here for Parametric NatCat solutions is that all of our solutions we offer, all of the covers we offer, they are highly customized. It all comes down to the individual need of a client, and we use historical events to backtest the structures, what the cover would have paid under a certain historical earthquake or hurricane event, and then we can see if that is aligned to the actual losses sustained. We still have capacity. We receive questions now in the Caribbean, for example, if we still have available hurricane capacity. Yes, we do. And we see many times limits between 5 and 10 million, for example, to cover deductibles. That was the example before in Mexico, which would outline that. Let's move on and quickly discuss solutions to secure capacity and control rates. So we offer multi-year solutions for single or multi-line. So the idea here is to lock in critical capacity for more than 1 year. That could be, for example, for 3 years. And in this example here, we have a tower. We carve out a certain layer for windstorm, and we lock in that capacity for 3 years. It's non-cancelable and indemnity-based. Then what we have seen also in Latin America, there is a trend to set up captives. So setting up, if a corporate sets up a captive, they have much more control about the insurance purchasing and are less dependent on the reinsurance market. So that's a very nice way to control and secure capacity and control rates. So where we come in is if a captive is set up, for example, in one of the typical domiciles in the Caribbean, the captive most of the time is not licensed locally as an insurer to seed business, for example, from the Mexican operation into the captive. So here we can help analyzing our insurance or reinsurance fronting capabilities. It can be pure fronting, or we can also participate in the program upfront or offer reinsurance to the captive. And the needs are typically related to licensing, any regulatory requirements, or commercial purposes where the corporate has to show locally that there is an insurance contract in place. We would indemnify in case there is a loss, and the corporate would re-indemnify us, and this would be taken care of in this additional indemnification agreement. And any other protections related to the captive itself, we can also offer. For example, what we see, self-insured retentions increase over time. We can help to securely increase the self-insured retention with what we call a step-up protection to grow the retention over time, or secure based on the increase of retention. The corporate detects there is a very heavily exposed layer in this picture here. What we would like to show is this little red layer is like a layer 4 excess 1 in a self-insured retention of 10 million, which is heavily exposed to, or could be heavily exposed to, frequency losses. So we would offer a sideway protection for accumulated losses in excess of, in this example, 15 million. So once 15 million losses have occurred, the cover would attach, and we would cover 50 million, and then we would, the exit point is at 65 million. So we would provide a cover for 50 million sideways to cover the heavily exposed frequency part of the self-insured retention. Just to give a couple of examples. What do we do now if a client, a corporate, is actually ready, thinking about analyzing of setting up a captive, but the captive is not yet in place? My colleague Thomas will guide you through that part.
Thank you, Andrea. Good morning, everybody. I can move to the next slide. So, I mean, it's very interesting, right? We're talking about hard market solutions, and I think we covered already a lot of what is possible. Andrea mentioned when she talked about parametric solutions, more about a different way of how our insurance promise as an insurer is delivered to the market, with that increasing speed and simplicity of coverage. And in the second part, Andrea alluded to, how we can basically better manage in a hard market the capacity, and also how we can finance risk. And as she said at the end, many corporates are at this point in time considering the setup of a captive. And what I am now presenting to you in the next couple of slides is a solution that actually addresses those corporates who have actually decided that a captive, if they would have one, would be the right answer to their insurance needs, again, with respect to capacity management, rate management, and also risk financing. And this is what I'm going to talk about, because we have a product now that is called Virtual Captive, and it is for those who have a hard market situation at the moment and have decided that a captive would be the right thing for them, but they see that the time needed, the cost, and the complexities of setting up a captive is actually a big hurdle. It's something they shy away from. Now, on the other hand, also captives clearly have a more and more difficult regulatory environment. They also have more and more reporting requirements. And it doesn't matter whether they are on or offshore, but the whole regulatory environment has become ever more complex, and therefore is also a big hurdle for corporates to actually go for setting up a real captive. And last but not least, for many of those corporates who think a captive would be the right thing, they fear the fact that, once maybe the market situation is different, maybe they don't want to have the captive anymore. And when you're real captive, it's not easy to just walk away. You cannot just close the door. So what they would like to have is a more simple exit option. And with this product that we have, that's actually possible. So what is it? And how does it work? A virtual captive is basically a multi-year insurance agreement with Swiss Re Corporate Solutions that emulates the mechanics of a traditional captive. And with mechanics, I do not mean the legal mechanics or whatever, I mean the financial mechanics. And thinking about what contractual elements in such a multi-year insurance agreement do allow this emulation or imitation of the mechanics of a traditional captive, it's actually 4. So the number 1 is it has to be multi-year. Because what we're trying to do, we're trying to set up a multi-year insurance agreement which works very, very much like a captive. And as a real captive is there to finance risk over time, we also need a multi-year time in a virtual captive agreement to achieve the same thing. The premium is calculated such that it implicitly finances a larger part of the risk over time. If you think about it, in a real captive, the way you calculate the premium that has to flow into the captive is such that you say, we with the captive want to be able to finance the expected losses in the captive layer, right? By way of retaining or getting the right amount of premium from our subsidiaries. So the total amount of premium flowing into the captive should be enough to cover all the expected loss. And now this is how premium is calculated, same as a captive would do it. But because of that, and because you as a corporate or as may believe that your loss experience will be maybe better than expected, there is a low claims bonus. So the low claims bonus is at the end of the period of the agreement, and it is a payback to the client, and it becomes due, as I said, at the end of the period. So a low claims bonus you can think of as, the benefit of this of a captive's risk financing mechanism. So in case there is a good loss experience, something comes back. In a captive situation, in a real captive situation, if you would have a real captive, a captive would probably pay a dividend to the parent. So the low claims bonus is basically the same as a dividend a real captive would pay. On the other hand, if the losses exceed the expected amounts by far, and by far is of course relative, and we would have to look at the situation, but there can be an additional premium becoming due. That is the same as comparable to, in a real captive situation, an additional call for capital. So if the captive's capital is depleted because of an excess loss experience, they would call for additional capital from the parent to be put into the captive in order for it not to go insolvent and stop operating. So in a virtual captive situation, in the multi-year insurance agreement, there would be an additional premium. What are the advantages? We believe that there are actually a large number of advantages of having a virtual captive versus a real captive. And I wanted to list at least 5 of them. So first of all, there are obviously no setup costs and no efforts needed to really set up a real captive. Number two, you don't need to hand in a business case and wait for the regulatory approval or set up all the reporting procedures necessary for starting a captive operation. Then once the virtual captive is running or the real captive would be running, there would be expenses for captive management. There would be audit fees, consultancy fees, maybe government levies, maybe fronting fees, and so forth. All of this you don't have when you have a virtual captive. Then the implementation is much more speedy. In some domiciles, captives can be set up very quickly, but very quickly is still relative, right? Maybe we talk 3 months, 6 months, sometimes 1 year. A virtual captive is a multi-year insurance agreement. It can be done within weeks, maybe a month, maybe a bit more. It depends also on the client side very often. And last but not least, very clearly, behind the virtual captive, you have the Swiss Re Group's financial strength, and that is very often a strong argument. To offer a simple example of how virtual captive could work, this is really a simplified example. I do not expect that we see many of those in real life, but it is just here to exemplify and illustrate how this virtual captive actually would work. So on this slide, there's a lot of graphs. We will go from the left side to the right side, and I will start on the left side first and explain how the program looks, and on the right side we will then look at different loss scenarios. So starting on the left, assume there is a client today that has a program with a business unit deductible and insurance right above that, and assume the business unit deductible is 1 million. Now going forward, because of the current market situation, the client decides that actually the attachment point for the regular insurance program should move to 10 million, and underneath the 10 million, they would like to introduce a captive, and with that a captive layer. So the captive layer would be 9 million excess of 1 million. Now, because they don't have a real captive, they come to us for a virtual captive solution. And what we do is, and now we go to the big box, we introduce a virtual captive program. It runs for 3 years, so multi-year. And what it covers is 9 million each and every loss in excess of the 1 million business unit deductible, and assume an 18 million term aggregate limit. So the 18 million is also just an example to keep it very simple, but it could also be a different number. So 9 million each and every loss, 18 million term aggregate limit. And now the interesting thing, if you go to the bottom of that box, it says the premium is 3 million plus X. And we talk about the X in just a second, but the 3 million is obviously there to implicitly finance the first loss, if you like. The first, so 3 times 3 million is 9 million. So a first loss to this virtual captive program is financed through that premium. Now with that, obviously you can see the second loss, which is possible as well, is a risk. If you would have a real captive here, that real captive's capital would bear that risk of the second 9 million loss. In a virtual captive program, it is Swiss Re Corporate Solutions balance sheet which does it. And for that, of course, there is a risk cost that comes with it. So let's quickly look at that. On the bottom left, it's described. The X is the risk and other costs, and I will talk about the other costs in just a minute. But the first piece, obviously, is the risk of a second loss. If you look at the loss scenarios on the right side, in a no-loss scenario, you can see over the years the premium flowing into this program, and at the end of year 3, there is assume that there is an exit and that the program is stopped. There would a low claims bonus become due to the client after a deduction of the X, obviously. So the X is deducted, but the rest is due for a low claims bonus. Let's go to the bottom end. It's a full loss scenario. Obviously, there is there is 18 million, assume an 18 million full loss to the virtual captive program. Obviously, there is no low claims bonus available anymore. And what is basically in excess of the 9 million loss is on Swiss Re Corporate Solutions balance sheet and is just our loss. In a real captive situation, it would be the real captive's loss. I hope this was, a good example to a little bit explain how this can work. I think I want to stop here, and Oscar, I think we now open up for questions. Is that correct?
Yeah, that's correct, Tom. Thanks a lot. Thank you, Thomas, Andrea, for the insightful presentations. And now let's move on to questions and answers. So we have a couple of questions already received. I would like to remind you to use the chat box if you still have some more questions. The first one goes to Thomas Holzoy. So, are the governmental financial stimulus not going to create an inflation problem in the near future?
Yeah, so this is obviously an important worry, and so in the short term, a recession is, particularly the current crisis is defined by a lack of demand, and so all the stimulus is there in place to fill this gap, at least partially. And so, in the short term, there is and a lack of demand is anti-inflationary. So in the short term, inflation is not the problem. It would be only if there were too much stimulus, and given the severity of the recession and the limitation of the fiscal space, and I must say particularly in Latin America, the stimulus packages are big compared to what we have seen before in other situations, but they're not outsized in relation to the drop in GDP. So I would, in the short term, I don't worry about this. Yeah, it's the longer run where things are not so clear. If we get if central banks continue to or will accommodate and fund these higher levels of government debt, whether eventually this will translate into higher aggregate demand, and that needs to be seen. Yeah, so this is we're far away from this, and it very much depends on the future continuation of central bank policies. In the short term, no worries about inflation, just the opposite.
Thank you, Thomas. The next one, this one goes to Thomas, to Tom Keist. What is the difference between what is known as protected cell company, rent-a-captive, and a virtual captive?
Yes, this is a very good question. So the protected cell, when you enter a protected cell company agreement, you actually buy ownership in a certain legal structure, which is the protected cell company. So it means you still have to insert a certain amount of capital, and you have to actually also take this ownership. And apart from that, the protected cell company is basically comparable to the mechanics of what we are trying to do here as well. So the difference is a little bit the legal structure and the ownership, but apart from that, the mechanics are very similar.
Thank you, Tom. Now, Andrea, what is the maximum limit that Swiss Re Corporate Solutions would accept for a parametric insurance?
Very good question. So the cases I shared were very much prone to, for example, some deductible coverages or self-insured retention cover, where we typically and many times offer 5, 10, 20 million. But if we have a very good business case, we can, and we have done that before, we can also go up to 100 million. And if more limit is needed, we also have a Swiss Re group where we can back up capacity if needed. I hope that answers the question.
Thank you. The next one. Virtual captives, are they for 3 years only, or can they be done for a longer period of time?
Easy answer, yes. So typically it's 3 years to start with. It can then be extended, or we can also start with maybe 3, 4, up to 5 years. But usually these structures are later on extended, but don't have to.
Okay, thank you. This is an interesting one. Many of the Latin American captives have been set up with a main objective of tax efficiency instead of pure risk transfer. How does this virtual captive strategy match with that?
It does not match with that. So the virtual captive is intended to work very, very similar to a real captive with respect to the financial mechanics, but it is not intended to optimize tax situations or accounting situations whatsoever. We did have these type of structures in the past, in the 90s, for example. We did then have some serious investigations on these practices. And since then, these kind of transactions with, tax optimization purposes are basically out of scope.
Okay, thank you. This one is for Andrea. How does the rate apply to the total sum insured on the Quake product compares to the traditional markets approach?
Very good question. We haven't talked about rates. So obviously the rate online which we would provide applies to the limit of the cover we provide. And in terms of how much it is, so for earthquake, it depends very much on the payout structure and the geography where we structure the deal. But typically we see rate online of 3% and above, just to give you a very, very high-level idea.
Thank you. Okay, so another 2 questions to Tom Keist. Who keeps the premium during the period of the policy or the agreement with the virtual captive, and what would be, in general terms, the no loss bonus amount compared to the premium as a percentage of it?
Yeah. So as with a real captive situation, the premium would actually flow to the respective balance sheet, in this case, Swiss Re Corporate Solutions. So that means we keep the premium. And with respect to the low, it's not a no loss bonus, it's a low claims bonus. It is a percentage, as you say, and the percentage is basically 100% minus the X. Remember I mentioned the X. The X consists of the risk piece, which I cannot say. It depends on the risk, so this cannot be said. And then the other piece is the cost of providing this virtual captive and our balance sheet. And this is usually a percentage between 2 and 6%. Depends on various factors. One is, of course, it's long tail business, which is a bit more expensive, or short tail business, which is less expensive.
Thank you. Another one for you. virtual captives are combined with insurance layers, or just virtual captives instead of an insurance layer?
I'm not sure I understand. So there's various ways of setting up the virtual captive. You can basically install it as, it can become the primary insurer. So Swiss Re Corporate Solutions becomes the primary insurer and then buys in the excess of the virtual captive layer reinsurance behind. Or it can be a insurance policy which basically just applies to the new deductible, right? So if you assume you increase your your normal insurance program, the attachment point from 1 million to 10 million, you can basically apply the virtual captive with an insurance policy as a deductible buy down. Or last but not least, we can also agree with the existing leading insurer that we reinsure behind this leading insurer for the first 9 excess 1 million. So there's various ways to go about it.
Thank you, Tom. Now, Andrea, with respect to parametric coverage, is the use or destination of the payment absolutely a decision of the insured? And what about the proof of loss?
Good question. Yes, the payment can be used for whatever expenses a client occurs at the time of the loss. And it depends a little bit with respect to proof of loss of the jurisdiction. For example, in Mexico, there is no proof of loss required. So here, we would not have that requirement, but in pretty much the rest of the region, a proof of loss is required. And the way we are dealing with that, to be in compliance with local law and insurance regulation, but at the same time be able to pay very, very fast after an event occurred, is that we ask the client for a preliminary estimate of the loss, and based on that we proceed with the payment. And then there is a true-up a year later where the client confirms to us the final proof of loss amount. So that's the way how we handle that proof of loss requirement.
Thanks, Andrea. We still have time for a couple of more questions. Tom, would you recommend any particular type of industry which will be more suitable for the virtual captive solution?
No, I would go the other way around. I would say some industries are less good, less easy, and it's basically, simply said, because this virtual captive is on our balance sheet, there is ultimately risk to our balance sheet, and that means it still depends on our risk appetite. So that means if Swiss Re Corporate Solutions does have absolutely no risk appetite for a certain industry, then it will be a bit more difficult. This is the number one downside of the virtual captive, if you like, if you were looking for the downsides. There is one other one, and that's then about it. And the other one is that because this is a multi-year agreement, the flexibility of changing the program in this time is of course reduced to what we would agree to as well. So the flexibility of changes is a bit reduced, and of course the risk appetite of Swiss Re Corporate Solutions plays a role. Oscar?
Thank you very much for the questions. So with this, that's what we have for today. Thanks for being a great audience, and we appreciate your attention. And again, thanks a lot for the lots of questions we have received. If you have a second, let us know what you thought about the event by clicking on a number between 0 to 10 in the poll we have for you. And just for you to know, the recording of this webinar will be also available in the coming days in case you want to listen again or share it with any of your contacts. In the meantime, please reach out to any of us today, to the presenters with questions. We would be happy to continue the conversation with you, obviously, and obviously very important, if you need information in Spanish or in Portuguese, it is also available, and please reach us to us directly. And so thanks a lot. Enjoy the rest of the day, and hope to see you soon in a future webinar. And again, please stay safe and healthy. Thanks a lot.